This is Rob Roy of Elliott Wave Options, and happy to be here. Thanks for spending some of your trading day with us. And for those of you watching the recording, I hope that you'll find this something a little bit different, right up my alley. Fibonacci and Elliott Wave trading strategies. Kind of interesting. I thought I would start off with this quick story on how I got into trading Elliott Wave. As we'll go through talking about analysis versus trading opportunities within the wave three, which I think is a little bit different than what a lot of people talk about as far as Elliott Wave. We're going to add AI into the mix and talk a little bit about how AI is going to be taking over the world of technical trading. If you're not with it, you're trading against it. We'll show the performance of what I'm going to share with you today, as well as a trading plan along with it. So as I mentioned, September 11th has a meaning. We all know what September 11th represented, but for me, it has a meaning along the lines of Elliott Wave. I'm showing you the chart of the NASDAQ. This was back in May of 2001. I was doing an educational seminar on options. I met with a gentleman that was going to be speaking with me that I'd never met before, and we were in Cincinnati. Friday night, he comes in, he's talking to me about this Elliott Wave stuff. And back then I was a technical trader on Bollinger Bands, RSI, just real basic technical indicators, nothing fancy. Was talking about the world of options, etc. And when he started talking about Elliott Wave, it literally went in one ear and out the other. I didn't pay much attention to it. But then he showed this forecast. You can see the target line in the bottom right of where the NASDAQ was likely going to go on this pattern called a zigzag. And I was like, yeah, we had the low, we bounced. I don't see us going back and taking out that low. Didn't think it was going to happen. So remember, this is in May, and then September 11th comes along. I still had remembered this and had it on the chart on a watch list. And then we have September 11th occur. If you remember, the market was closed for 4 days. The market reopens and the NASDAQ goes exactly to the level that he had forecast back in May. We go sideways there for a while, found our footing, and that's when the bounce started. And at that point, that very point, the day that we hit that level, I contacted this gentleman and said, okay, I am ready to learn about this Elliott Wave stuff now. So I've been trading Elliott Wave ever since, but it's just kind of interesting that I'm here with you today on September 11th when all the other meanings of September 11th, but it had meaning for me as far as introduction into Elliott Wave. All right, so let's talk about trading versus forecasting. There is a difference, and I kind of have these chats with people all the time. I do a show on YouTube every weekend that's free, and we get a lot of Elliott Wave people there, and everyone just seems to be so caught up with labeling the patterns and being so precise and getting into the minutia of labeling the patterns. And I like to view things more from a trading standpoint. So Elliott Wave is used to help set up trades and enter and exit trades, not really so intent on making sure that I got every single Elliott Wave count correctly. You can do that. You can break it down, get all the way down to the microwaves if you want, but I tend not to do that. And I've met a lot of people. In fact, I just had somebody this past weekend that said they'd been manually trying to do Elliott Wave with not very good success. And I responded that I've yet to meet the person that could manually label Elliott Waves. If you've ever seen the actual algorithm that Ralph Nelson Elliott himself wrote, I don't see how anyone could do that in their head. So some of the differences between being an analyst and using Elliott Wave to trade are limited markets. If you're an analyst, more markets, search the entire markets for finding trading ideas. Look at a high level analysis as far as what's the bigger picture. Looking a little more in the short term, and that's what I'm going to share with you today, using Elliott Wave on a little more of a short term than that 5-wave impulse pattern that everybody's so used to seeing. Even you can go out on the internet and see that 5-wave pattern with a 3-wave correction. There's so much more to Elliott Wave than that. I'm breaking it down. So again, I think I'm going to share something with you that may be a little bit different, something that you haven't seen before. And as far as an analyst, you can use it to forecast, predict future market trends. That's really why Elliott wrote it. But here I'm looking for trading opportunities, not necessarily focusing on major market turns, etc. I want to actually utilize it to find individual trades. And the way I do that is using that zigzag pattern, what was shown to me before September 11th occurred on the NASDAQ. I really didn't know what a zigzag was, but I went and read an awful lot about it. And I was surprised to find out in reading Elliott's works, not just the published materials, but I was able to get a hold of some of his private notes and stuff. I mean, I really got into this. And Elliott himself felt like the corrective patterns were even more accurate than the 5-wave impulse patterns were. And the corrective patterns, as you know, are flats, zigzags, and triangles. I'm assuming everybody that's here has some basic knowledge, if not more in-depth knowledge on Elliott wave. And then the wave 3. And I was taught when I first got into it, unfortunately, the gentleman that introduced me to it, who mentored me for a short period of time, was killed in a motorcycle accident. And so I was left to go to other means after that to understand Elliott wave. And I was taught the same thing. Don't trade the wave 3, even though everybody in the world of Elliott wave agrees that wave 3 is the strongest of all waves. Stay away from it. Let wave 1, 2, 3, and 4 occur. And if they've all met the guidelines and rules within Elliott wave, then you have a higher percentage chance of that wave 5. But it always bothered me on, why don't we trade the wave 3? And the answer that I consistently got was, well, you don't know where the wave 3 is going to end. And so my thinking was, well, what if we can figure out where the wave 3 is likely to end? And that's where the zigzag pattern comes in. It can help us identify where the wave 3 is going to end. So just doing some quick refreshers here. I know this is real basic for a lot of you, but it builds in the basis of the presentation, if you will. Normally, zigzags are corrective patterns. So you have the A wave, B wave. Most of you are probably all aware that every 5-wave impulse pattern starts with a zigzag. Not every zigzag turns into a 5-wave pattern, but every 5-wave pattern starts with a zigzag. So we've already got one feather in our cap there. And then when we're looking for the C wave extension, we look at those fib levels, 61.8, 100, or 161.8. And we'll talk more about how we identify which one of those we're looking at. And so I use these terms interchangeable with extension moves within corrective patterns. Basically, they're the same thing. You can have a zigzag pattern that's an upward zigzag within an upward wave 3. So you could argue they're both impulse patterns, even though the technical name of a zigzag is a corrective pattern going against the previous trend. So let's get into trading zigzags within a wave 3. As I mentioned, all 5-wave patterns start with a zigzag. So we're going to look for opportunities within the wave 3. That's how we can get an idea of where the wave 3. And so if we have a high percentage chance, and it's only a 3-wave pattern, of figuring out where that wave 3 is going to end, and we're trading in the strongest of all waves, it just seems from a common sense standpoint that that would give us a higher percentage of accuracy. We all know that the wave 5 is more on the retail trader side of things. Let's trade with the institutions. Let's trade with the big money, the big volume. That's what I was looking for. And so after we get that B wave correction in a zigzag within the wave 3, that's where we start looking for entries. And we'll give you specific rules on that as well. So I'm going to talk rather fast because there's a lot I want to cover and make sure that I get done on time. So hopefully you'll be able to go back and watch the recording if there's anything that you miss. But zigzags provide the location to enter within the wave 3. So that's what we're looking for. How do you know when to get in the wave 3? We're going to bring in AI that enhances this as well throughout this presentation, and they give you the targets for exiting. So not only do they give you the entry targets, but more importantly, the thing that everybody was always cautioning me about in my early days of trading Elliott wave, how to get out or when to get out. It gives you those guidelines as well, utilizing the Fibonacci extensions within that C wave. So I was doing this, and then had an opportunity to work with some folks to integrate AI. And they're people from the Hub organization, hubb.com. So I sent them my technical trading system and said, hey, you guys are kind of the leaders in AI, and they literally have scientists. That's literally what they are, that were programming AI. They were some of the first that I'm aware of. And they also had an Elliott wave background. And so they were looking to program AI signals in the first part of the wave 3. So that's where I said, hey, let's look at the wave 3 instead of looking at the wave 5 like everybody else does. And I started back in 2020 with them and launched a service sending out alerts to customers back in 2021. So I really think that we're ahead of the curve and utilizing AI, and I'm going to show you exactly how it works. And you have access to the software as well in these trade setups. So the hub scientists provide extensive input data. Obviously, they took my basic technical trading system, which I didn't think was so basic at the time because I'd spent hundreds of hours going through trying different combinations of indicators, et cetera, to create it. But they took it and supercharged it and made it seem basic at that time. And some of the indicators that they use are pretty basic that everyone can find out on the internet: price of volume indicator values, benchmark comparisons, indicator value rankings, statistical measures, intermarket correlations, economic cycle data, company options data. You look at those and say, yeah, we can all find that. And that's true. If you have the computing power to analyze all that, and you have the knowledge to put in these AI type models. And this is where it started to get away from me. Regression, clustering, random forest, ensemble, and neural networks are just some of the AI that they use. I'm not familiar with many of them. Neural networks, I do know the basics of what that is. In a very general standpoint, that's where you give the AI a situation or a problem and you ask the AI to solve it. And if you're wondering, this is true AI. The cool part about this is what I'm going to show you. The AI is consistently learning what worked, and it's factoring that into the next set of signals that it gives out. So it's only going to get better and better as it further and further refines over the years these signals that are sent out and the targets that are hit. So it's pretty amazing. Well, I reached out to him and said, oh, okay, I'm more of a visual learner. Can you send me something that I can grasp? You know, we all learn in different ways, auditory, visual, whatever. And this is what they sent me, which a lot of people said, oh, that looks like an ultrasound. But each one of these data points has a chart that looks like this, and the coding is up along the top. And then they sent me a bunch of them. And once again, I was a little confused about exactly how it worked, but I do know the gist of it. And I'm not going to show you all of them. There's 300 of them. And then they sent me this listing of the top 36 that they consider of their 300 data points. And they look for the correlations within these. In other words, every single one of these has its own code. Every data point has its own code, and it creates a cluster on the chart like this. So then the AI takes all of these and says, where's the agreement? Where do the clusters agree? So in other words, where are we getting the greatest amount of agreement from all of these different data points? And again, just from a common sense standpoint, if you can get that many data points to agree in a correlation, and you know, to me, it looks more like a dot plot, which you hear about from the Fed all the time, but ultrasound's what most people say. But that's what the AI is doing. It's analyzing all these data points, finding the clusters, and then finding where the clusters agree to generate signals. This is what the customer sees. Someone that's utilizing this software. And as I said, I'm going to show you how you can access this software as well. And so you have a chart and it gives you the target. It gives you the AI score. At eBookTrader.com, we send out alerts to subscribers that have signals of 75 or above. You can actually get access to the software now if you want. Use the AI signals or utilize the alerts. You don't have to. You can just use the software. And it gives you a fail zone, which is a big deal because I'm going to show you how that works in difference to how an Elliott wave zigzag exit might work. It actually gives you a little bit earlier of a stop. So the fail zone would be considered the stop. So 84% chance that you're going to go up and hit this target. And another part that I like about the AI is it's just looking for little chunks of the wave 3. We're not trying to enter at the beginning of the wave 3 and exit at the end. Nobody enters at the bottom and gets out at the tops. We all know that from the world of trading, at least on a consistent basis. Nobody can do that. And the AI is not trying to do that either. The AI is trying to figure out where do we have the greatest percentage chance of making a bit of a run here that we can capitalize in some sort of an options trade because we are trading options. So that's what it looks like. That's what someone that has the software is going to see. So again, as I mentioned, You could find some of these indicators, and if you had the computer power, the programming knowledge, the AI knowledge, all that kind of stuff, you could do it yourself. But I'm going to go ahead and preview what I'm going to share with you at the end. You can see this Elliott Wave tool in action for free by going to hub.com. So www.hub.com. You can get it. Just went live. It's been in beta form up until the last week or two. So it just went live. So you can go there, register, and get the Elliott Wave signals. They're intraday signals as well. So if you like to trade intraday, all the same rules in Elliott Wave. Again, most of you probably already aware of this. Work no matter what time frame you're looking at. I like to look at 3-minute charts intraday. I trade most of the time on end of day signals, and our alerts are sent out on end of day signals. But personally, I look at 3-minute charts. And if you're interested in the AI signals, you can also find information on that at hub.com as well. Now, that is a subscription, but there's a founders member special right now. I wanted to show this early in the presentation because this is a big deal. The data scientists and people have asked, well, how do you know they're not going to go somewhere else? Well, the Hub organization has them wrapped up legally with all the agreements, et cetera. But part of the thing is that, one, they're not going to share the coding, so they're keeping the intellectual property. They send out the signals, but not the coding. And then the other side of it is the fact that they don't want everybody under the sun to have this. So they are going to limit the number of people. You know how it all works. When everybody's looking at the same thing, it doesn't work. That's just how the markets are in general. When everybody's viewing the market one way, it goes the other way. So they want to keep this into a confined group of people that are really excited about trading Elliott Wave and AI. And again, you can have access to it. So go there and you can get the Elliott Wave signals for free, the subscription for the AI signals if you want those, and take a look around, kick the tires, if you will. You know, it's nothing to lose on the free stuff with the Elliott Wave, and again, the live Elliott Wave intraday chart. So here's how the system works as far as performance, and then we'll go through the nuts and bolts of it. So 83% winning trades, and normally when you look at that, I remember a time when somebody told me that they had something that was right 83% of the time. I would have said, BS, no way. But this is proven. These are actual signals that have been sent out. There's a track record, there's documentation. The average return is 27%. So again, we're looking for little chunks. So if you can do that on a consistent basis, so you have a high percentage chance, even though these aren't big, huge winners, massive, eye-popping numbers on the returns. If you can generate a decent return on a consistent basis, you can build an account pretty quickly there as well. And these are non-compounded results, by the way. So 141% on the return on investment. Average time in trades 24 days. I'm going to show you a little bit more about that because that really made a big difference for me. The first system that I sent out wasn't the zigzags on the wave threes. That's the one that started in 2021. We started in September 2023 doing this zigzag within the wave threes on the AI. And here's been the results. There has not been a losing month yet. I'm not going to say there never will be, but so far there hasn't been. That was through June. July and August were both winning months as well. In fact, August was a very good month. And so you take a look here, hypothetically, if you started with a $5,000 account using this system, and we put no more than $500 at risk per alert that's sent out, that account would stand at $12,232 right now. 2.4 times your account in just 10 months if you were doing all the signals. And again, that didn't count July and August, which were winning months as well. This is how it's affected me personally. My average time in a trade for trading even in zigzags and wave threes was just under 50 days, so about 48 days. And we had COVID, and then that's where the AI signals began. And look what's happened to the average amount of time in trades. All of a sudden, it's been more than cut in half. So that's where the 24 days comes from. So rather than 40 plus days, it's down to 24 days. So half the amount of time in a trade, and the trading activity level has gone up significantly. So here we go. Once the AI started, so we got 3 times the amount of alerts going out, and we're in the alerts half the time. So that's a win-win. I think you would agree. So you're getting more signals, you're in them less to hit their targets. It's just been great. It helped me set a new personal best of 19 consecutive close winning trades in a row. My previous high in my entire trading career had been 13, so it just kind of blew it away when the AI was given in. And here's the documentation that I was talking about. It's posted on the website. These are all, you can see the AI strategy here. Impulse AI is what we call it. And there they are. There's the 19 winning trades in a row. And just to let you know, these aren't just hypothetical on the entries and exits. We actually have actual fill prices that we know our subscribers achieved on these. So it's as clean as you can get as far as documentation. So let's go through a quick refresher on zigzags, the key zigzag rules for going through this. Again, many of you are probably aware of this, but we'll go through and talk about it anyway. As a rule, wave B must retrace at least 20% of wave A for it to qualify. And if you're familiar with Elliott wave, you know there's a difference between the word qualify and confirm. So qualification and confirmation are two differences. And this is one of Elliott's guidelines. He didn't really like the 23.6% fib level. He wanted it to go down at least to 30%. So would have preferred the B wave go down to 38.2% on the fib level. Although he did acknowledge that it would qualify at 20%, but a guideline for preference would be more towards that 38.2% level. And then if you break below that, then you could be looking at the potential, instead of an upward zigzag, a potential flat. So if wave B retraces further than 70% of wave A, suggestion is you're probably creating a flat pattern here, not a zigzag, even though technically it'll still label it up to a 78.6% fib level. But once again, in Elliott's writings, he felt like if you got to 70%, there's a high likelihood that it's going to become disqualified. In other words, the zigzag would be disqualified and probably move into a flat. So once you got past 70%, he didn't hold a whole lot of belief that the 78.6% level was actually going to hold. Again, some of this is probably review for a lot of you, but others of you that aren't familiar with zigzags, and boy, I went right to it in reading the materials once I found that Elliott liked these as well. I'm just like, why don't more people talk about this? If the guy that created the entire system favors these patterns and views that they work a higher percentage of the time, why is everything we see 1, 2, 3, 4, 5 ABC after that? So wave C must be longer than 90% of B by price. So when we're looking for that movement up in the C wave, that's where it becomes qualified. And then once we get up to the target, the C wave is likely to move the same distance as A. So the move of 90%, remember, is of the B wave in wave C, and then the extension of the C wave, the movement from B to C, is usually going to be, in general terms, about the same length price-wise as the move from 0 to A, so the A wave pattern. So that's the general basics. Second most likely is for the C wave to extend 61.8% of A, and then the third most likely is 161.8%. It's amazing, especially with this AI infusion in these zigzag patterns, on how far those C waves go. Now, the AI doesn't look at the zigzags. The AI starts examining the data points once the first day of the wave 3 is labeled. So again, remember that every 5-wave pattern starts with a zigzag. So once we've gone from an ABC into a 1, 2, 3, that's when the AI kicks in. So we're trying to catch the earliest part, or they are, of the wave 3 and catch our piece and get out before we start to look for that wave 4 correction. So here's some guidelines on these zigzag patterns. If the B wave retraces 38.2%, you look for the C wave to extend 61.8. Again, all fib levels. If the B wave retraces 50%, then you're looking for 100% C wave extension. And then if the B wave retraces 61.8%, you're still looking for 100% extension. That's my favorite of all. To me, just a personal preference, 61.8 is the strongest of all fib levels, at least it has been in my experience. So I love seeing the zigzags when the B wave comes back to 61.8. And people say, well, if it is one that only goes to the 38.2% correction and moves up, then if we're just waiting for the 61.8, we're going to miss those, and we're going to miss the 50% ones. So a risk management system that you could consider is, if you want to catch all of them, whatever amount of money that you determine based on your own risk tolerances. We all know our own risk tolerances. You look to put a third of a position, a third of your risk capital. If it hits 38.2 and starts to bounce, if it comes down to 50%, put another third. And if it is one that's going to come all the way down to the 61.8, then you add your final third. Or you can just simply wait and only trade the ones that come down to 61.8. So I've done both. It just really depends on how the system looks and what the AI is telling me at the time. So here's the trading plan to utilize this. So we take the basic zigzag setup, identify the signal day, qualify it from a risk to reward standpoint, enter upon the confirmation day. And as far as exiting, we're looking at those Fibonacci levels, monitoring volume as well. I'm a believer that regardless of what technical trading system you use, whether you're using Elliott Wave, Fibonacci levels in your technical trading system or not, price to volume always matters, in my opinion. So any technical trading system should contain price to volume. I don't think there's any substitute for the fact that if a stock is going up on good, solid volume versus a stock that's going up on weakening volume, there's a difference between those two moves on what's likely to occur following that. And then my favorite confirming indicator for these is the DMI. It was created by Wells Wilder, who's actually the same guy that created RSI, but a lot more people look at RSI than DMI, which I like. So not as many people follow this. The ADX gives you a confirmation of the strength of the trend. And then you have two directional indicators that tell you who's in control, buyers or sellers. So even though I'm a huge believer in Elliott Wave and nobody can convince me otherwise, been doing it for too long, since 2001, I still feel like nobody should rely on any one single indicator. You should have a technical trading system, and that's what really has been built and intensified with the infusion of AI in my system over the past few years. So the basic zigzag setup looks like this. First of all, you identify the 0 point. When is the previous downtrend changed? Move up. You look for that first impulse move. Let that happen in the wave A. Now we're watching when we see a corrective move in the wave B. We look for those rules, the 20% movement in wave B so that it qualifies, and then the C wave extension so that we know that we're looking at C wave move to the upside. And the note here is that you can adjust this a little bit slightly on the C wave extension. Basically what that means is that if I'm looking at a pattern and I see this B wave come down and it hits the 61.8% fib level and bounces, I'm probably not waiting until that C wave goes 90% of B before entering a position, especially now if I have the AI giving a strong signal on top of it. That's what that means, is that once you get really good at this and identifying when the B wave is likely complete and you're bouncing into the C, you don't necessarily have to wait until that C wave moves a full 90% of B, because as you can see, you're giving away a chunk of the potential move already if you do that. But you can. Everybody views things differently, some more conservative, some more aggressive. Then we look for those fib extension targets as far as where that C wave extension is liable to end. So we identify the signal day. That's when pattern becomes qualified and the entry threshold is once close above that, and then you're in, or a little bit sooner if you want to relax that. So remember, qualifying and confirmation, two different things. So when we look at this from a risk to reward standpoint, we want to look at what we're risking against the relative trend. Now, in general terms, from the zigzag standpoint, the risk would be if we were to come back down to where that B wave was. So where the B bounced, whatever fib level that was, Even though we've had the qualification, the risk would be from the qualification point down to that B wave entry. Well, now we have another indicator in for the risk part of it, which is the fail zone within the AI. And oftentimes that fail zone actually is higher than where the B wave was. You may have noticed in that chart that I showed you before, the fail zone was higher than where the B wave was. In other words, you have a shorter amount of risk or less amount of risk on a failure before you come down and take out this B wave, which would be the normal zigzag exit from a fail point. So your risk is less, is basically what I'm spending a long time talking about here. But risk management is always important in the world of trading. Everybody's aware of that. So the reward area here is from 61.8 up to 100%. Once you've passed this qualification and confirmation on the entry. And so there's your risk to reward standpoint. And you obviously want to have a higher percentage of reward to risk. The AI kind of takes care of that for us now. So this is general from Zigzags. And once again, the AI has improved upon what would have normally been your risk management, risk management system within Elliott Wave. So other considerations, potential reward, how large is the zigzag, how far can it run before hitting key fib levels. I'm going to show you what I really like when it comes to setting these up along with the AI. We already talked about the risk is where that B wave correction is. And then we take the next point from the options analysis. We're not going to talk about that in this presentation, but also look at where's the best delta gamma relationship. You can utilize any strategy on these. You know where that fib target's going to be. You can even put an out of the money butterfly on there if you're a fan of more advanced option strategies or even a time spread, calendar spread up at the point, or simply put on straight calls and puts. You don't have to necessarily do the more advanced strategies. And if you are using straight calls and puts, because this does work to the downside as well, you can look for, in my opinion, the ideal option is the one that gives you the best delta gamma relationship. And sure, you know, delta is the amount of money that an option will make or lose on the next dollar the stock moves. After it moves $1, there's a new delta, and that's determined by the gamma. So where is the greatest acceleration of the delta from the gamma? And there's a particular spot on the delta curve that we look for with our options when we're placing them. But again, that's fodder for another day. So when do we enter? Confirmation. So now that we looked at the zigzag setup, how do we know when to pull the trigger? That's on the confirmation day. And we're looking for a couple of things here. We want the price action and the confirming indicators to agree. And then let's talk about this confirmation day. Now here you can see that we have the zigzag pattern within here on the potential move higher. This doesn't have the AI added onto it yet, but we're going to add that piece on here in a moment. So there's the point where you have the 90% retracement of the B wave. So that means you're qualified in the zigzag. We've closed above that day. So now we have confirmation. So we're ready to go. And we're looking at these fib extension levels to give you an idea of where the target may be. What I utilize once you hit the first target, so you can see the B wave here is roughly 61.8. So this would be one of my favorite setups. I love it when the B comes down to that 61.8 fib level. And then at that point in time, you're looking for 100% extension. Remember the charts that we used on the B wave corrections, but a high percentage of the time, the C wave will go on and extend to the next fib level. And that's where I'm really focused on the DMI. The DMI gives me an indication, specifically with the ADX, of how strong the stock still is once we hit that spot. And then the likelihood that we could continue up to the next fib level. And that gives further confirmation if we actually have the AI signal above the fib extension level. So you can get two signals there. You can get the DMI telling you, yeah, you're still strong. And then you also have the AI telling you, hey, we're probably going to extend the C wave past the 100% extension and go a little bit further. All right. So when is it time to get out? Exiting. Always, if you're happy with profit that you have, you don't necessarily have to hit the target price. And I always talk to people about this, especially newer traders. If you exit a trade and you were happy with the gain when you exited the trade, and then you go back and look and you're like, gee, I could have made more if I'd have stayed a little bit longer. You're going to drive yourself nuts if you do that. And it'll just eat you up. If you were happy with the profit when you close the trade out, be happy with it, move on. That trade's over, forget about it, and move to the next trade. And that kind of goes back to some of you that may be familiar with my past. My first career out of college was as a golf pro. I was a golf pro for 13 years, and then I've been a trader ever since. So only 2 careers I've ever had. And it's really interesting on the similarities. If you have a really good hole or a really bad hole in golf, you can't get too high or you can't get too down on yourself. That hole's over. Forget that hole, move on to the next one. Same thing in the world of trading. If you had a great trade, awesome. Forget about it, move to the next one. Keep your wits about you, if you will. That's what they say down under. The hub organization is from Australia, so I hear a lot of those phrases in chatting with those guys periodically. But there's a lot of similarities when it comes to the two, which is kind of interesting. Every trade is different. When you play golf, you can play the same course every day, but you're going to have a different round. Even though you're playing the exact same course, every round is different. Anyway, I digress. We'll move back to the important stuff. If the pattern fails, exit the position. You hit the fail zone, get out. Don't wait and hope that it's going to turn around and come back, because that doesn't work. Just have the conviction, follow the plan. And that's the great part of this, is both the profit and the loss are detailed for you. You don't really have to think too much about it. You just put the trade on, watch when one of the 2 levels is hit, you exit and move on. In the world of options, you're going to want to make sure that you go out far enough in your options trade to give the pattern time to play out. And you also want to make sure you don't go too far out in time, destroy that delta gamma relationship, because the longer out in time, the less acceleration there is between the two. So if you're trying to maximize that, there's a time frame to get into. Maybe we'll do options analysis at some point in time. The software is actually going to do that in the next release, which will be really cool as well. So let's go through and look at some examples of some actual trades. Here's one that we just recently did. As you can see, the entry date was on August 22nd. And here's the chart. It was on EPR. And so here's what we're talking about. Look at that zigzag pattern there. There's the B wave, came right down to that 61.8% fib level. So I'm already excited about this one. This is one we had done before. See where it says target price reached? We had actually had this one as an AI signal, went up to the target, and look how accurate it was. Where that red line was, that's where it hit. And then we had another zigzag form. So we got into dueling zigzags here. And this B wave correction also right at the 61.8%, back into the wave 3 here. And you can see here, these are the ones that I really like. Notice where that C wave extension is. So the 100% extension on that 61.8% correction, and the AI target, this one was an 82% score, are almost in the exact same spot. That just boosts your confidence. Neither one of those is 100%, right? There's no guarantees on anything in the world of trading. All we're trying to do is gain that little edge, and that's what the AI gives you. I felt like there was already an edge trading a zigzag within a wave 3. The AI just furthers that. So we get the greatest edge we can get, but nothing's 100%. Nothing works every single time. But track record has been pretty phenomenal so far. So that's what the setup was. And then when we moved up, now notice here, this was on the exit day, and you can see that it went vertically up. It just shot straight up. Now, I'm also a believer that no security in any time frame gets too far away from the 10-day moving average. So that's what that bottom arrow is pointing to on the chart. That's the 10-day moving average, that lime green line. And you can see where the stock is trading. Now, we haven't hit that C wave extension or quite that AI target yet, but we had a huge up day. So there's going to be an infusion of IV into the call options. As you can see, this was just a straight long call. And again, plenty of time. It was entered in August using Jan 25 options, but we're overbought right now. So we've got that infusion of IV because we've had this vertical move. We're overbought short term. Likelihood is that we're going to consolidate or perhaps pull back. So when I see that, I'm more apt to go ahead and take it off. So people ask, well, why did you take it off before it hit its target? That's why, because if we go sideways, that extra IV infusion in the call options from this vertical move will be taken away. And then if it does go through a little bit of consolidation or maybe some backing and filling before it goes on to hit the target, then you have theta decay to worry about as well. So you have both of those issues occurring. So with that standpoint, you want to go ahead and take the gain while you can, even if it's a little bit less. In this case, it was 36.5% in one day. It would just happen the next day after the entry. It took off. There's also a mark-to-market graph here, which shows where the position is every day. And you can see this one never had any sort of drawdown. And when you're trading straight options because of time decay, extrinsic value movements, it's not unusual to have a little bit of a drawdown from time to time while the trade takes its time doing what it's going to do. But in this case, there wasn't. It just went up immediately, and those are fine. From time to time, the AI identifies a strong move, an impulse move, just taking from Elliott wave there, and it goes straight up. Now, handful of times every month or two where you have the trade that's only 1 to 3 days long. But I did want to show you another example of one that takes a little bit longer. So I don't want people thinking or having unrealistic expectations that the AI identifies something and it goes there the next day. It happens a lot and it's fun when it does, but it's not something that we count on or would necessarily be considered commonplace. So here's an example on Chubb. Here's the setup here. Once again, a zigzag within a wave three. So looking at that pattern, and there's one that there, the zigzag started an impulse pattern. So you can see the 1, 2, and 3 are labeled. That goes back to that rule that every impulse pattern starts with a zigzag. There you can see the fail zone there. That's going to be interesting to watch here in just a second. 77% score. This one's moving up. Now, this one looks just like that EPR trade, right? It looks like just like that one. It's in a strong impulsive move. And perhaps we're going to run up and hit that target rather quickly. Didn't work that way on this one. You can see we had a pullback first, and it actually came right down to the 50-day moving average at that time and got right down towards that fail zone target. I thought maybe this is going to be an extremely rare one where it actually didn't work, and then we had to take the exit from the fail zone, but it didn't. It bounced just above it and ran all the way up and eventually hit its target right exactly where it was supposed to go. But it took a little bit longer. And so you can see the results in this one. This one was 33 days. So the one trade took 1 day. This one took 33 days, and the two patterns looked identical. In this case, is over a 23% gain. Obviously, with some time going by, there was some erosion from theta decay. And look, there was actually a 50% or greater drawdown as it took its time. And that's what I'm saying. If you're just trading straight calls and puts, and it takes a little while to get there, you can see that there's going to be a little bit of extrinsic value coming out of the options, but yet it turned and ran and did exactly what it was supposed to do. So now you can see the average. One example, and there's tons of them on the website at eBookTrader.com of 1 day and then 33 days. The average is out to 24 days. We like the quick ones, but in general terms, it averages out along those lines. So that gives you an idea of how things work from utilizing the AI within the wave 3 of the Zigzag. So I wanted to give you an exciting one, the 1 day one. And both of those were recent. If you notice, both of those were in the last couple of weeks. So just as a reminder, if you're not trading with AI, you're competing with it because there's stuff like this out there. I do think the Hub organization is leading the way. Happy to be associated with them at eBookTrader.com. We are separate companies, just to be clear, but you can access this software again by going to hub.com. That allows you to get the free Elliott wave signals, free intraday Elliott wave. It has every technical indicator that you can think of. It's going to have options analysis very soon. And then if you are interested in the AI signals, you can go there and read more about it. It is a subscription, but there's a founder special right now. There's only a handful of spots left. To my knowledge, I believe there's still a few. If you wanted to take advantage of getting those AI signals and utilizing it within what I've showed you, trading zigzags within a wave 3, or utilizing it in your own technical trading system. However you want to manage the signals and move them in with, if you're just buying straight equities, or if you're an options trader, as I am, however you want to utilize it, you can take advantage of it there. So I did want to actually show you the software here while we've got a minute before we move into the next presenter. And so here's what the software looks like. And here's the S&P right now. And so this is showing you that we opened, traded lower. We're trading up towards the high of the day. And then if you want to move into the intraday, you can change it and come over here. And then there's the 3-minute chart. Now I look at 377 data points for labeling the Elliott wave. And by the way, this software program codes the Elliott wave algorithm exactly as Ralph Nelson Elliott wrote it. I know there's a lot of Elliott wave softwares out there that are personal adaptations of Elliott wave. This one is exactly to the algorithm as Elliott wrote it. My view is that if you're going to trade the guy's system, then trade it the way he wrote it. When you have personal adaptations, you got to figure out exactly what they are looking at. So the data points here, 377 data points. The default's 300. I go a little bit higher than that because, Elliott wave does relabel at point in time. And I found that by doing this, it will eliminate some of that. So now we take a look and it gave it, every bar is 3 minutes now. So every data point is 1 bar. So if it's an end of day chart, every bar is 1 day. And now you can spread the chart back out. And you can see that intraday, we're in a wave 3 where the wave 2 was a quick move down there around 11 o'clock. So we bottomed out. That was the end of the downward move. And we've been trading in an upward move ever since. So the movement here in this wave 3 to the upside, and you just saw that new bar added. You can watch and trade Elliott wave live with it, which I think is really cool, and put on your own indicators if you want. So there's the ADX. I look at that and that's confirming that, yeah, you can see that ADX moving up. That's a pretty strong wave 3. And you can trade intraday if you want to. Not trying to encourage day trading, but people do it, and you might as well have good indicators if you're going to do that. So that gives you a little bit of a viewpoint of what we're looking at here. I'll see if there's a few questions, perhaps that I can answer from anyone. I don't use candles. I use bar charts. And so that is why I have the bars on here. But if you want to change to candles, you can do that over here. Move them to a candle chart pretty easily, pretty quickly, right there. And so whatever your preference is, I just learned to trade on bar charts, and I haven't changed, but I know a lot of people utilize candles. So whichever your preference is, and then I keep them black, but you can color them with up bars and down bars if you want, green and red. There's all kinds of different things that you can utilize with this. But over here, if you have the AI signals, which literally just launched last week, you can click right there, and you can see there weren't any bullish signals last night. But then you can look on the bearish and it says wave three, because once again, it's identifying the first wave three signal. Now, we look for scores 75 or above. You can see this FXN here is a 57 score, so that's not high enough. But it's fun to monitor them and look, and you can see that on today's move, we are off the low of the day, but on the low of the day, we were getting awfully close to the target. And notice that it's gray here because it's telling you, that's a gray area, not quite as high as the 75% signal that we would like to see. And if it bounces back to the upside here, that would be your stop. That would be the fail area. But now trading to the downside on the low of the day, even though the signal wasn't high enough, but it does give you an idea of what's occurring here. Very similar thing here on Darling. On the low of the day, got awfully close to the target. Pretty much everything's bouncing now with that intraday wave three that I was showing you on the S&P. But that's how it works. And then the very first system that I utilized was sideways. And this is on stocks that have had a big drop. And you probably saw the news from Ally yesterday at that big financial conference. They said that they're concerned about where the consumer is at this point in time. And so they dropped big, and they've had the financial sector in a little bit of a tizzy the past 2 days after they came out with that, even though Bank of America and some others at the conference said, yeah, they've seen some weakness in the consumer, but not what Ally was talking about. So stock had a huge drop. And then this gives you a score on whether or not it's likely to stay in a 1 standard deviation range. That's those two boundaries here. It's 1 standard deviation on the move following the drop at a 44% score. That's below 50-50. So you'd almost feel like there's a better chance this breaks out, which is something that you can utilize with this as well. You can actually fade the scores if you get a real low score. One of the things the data scientists, and it took me a while to embrace this, is that if you get a very low score, you can actually fade that move. Here's an example, ICLR here, that only had a 22 score. That's very low. You can see it's red. It's like, no, don't look at this one. And look what's happened today. It's moved to the upside. Even on the open, it opened higher, even though it was in a wave three to the downside. The AI gave that a real low score. It's kind of a neat little nuance that you can utilize in your trading now. You don't have to just trade the high scores on the direction. You can fade the lower scores, and it's turned out to be very successful. As is my habit, when the data scientists first told me about that, I was just so excited about seeing the signals on movements on high scores that kind of went in one ear and out the other, but they kept harping on it. And so I was like, okay, well, if they're that big on it, let me take a look at it. So there's a perfect example, just live right here while we're talking, just to look at one, and you can see it's really cool with the AI signal. So I'd encourage you, if you find this interesting at all, to take advantage of it, because it isn't going to be available for everyone, and it's not going to be available very long, but it is right now. So the timing of this is really good. So once again, hub.com is where you want to go. The AI for any in the futures, right now it's just in the US market, but they have all of the cryptos are in there, futures, commodities, all that's coming. So far, it's just the US market, but they also have data they've actually been working, and they had the same problem. The programming of this is so new because it started from scratch and programmed it from the beginning. When they worked with the data providers, they actually had to help their programmers update their programming so it would talk to this software program pardon me, to get the data in. And so they got that done for the U.S. market, and now they're working on the international markets doing the same thing. And it's supposed to be in the next release. So within the next couple of weeks, it's going to have all the international markets as well. But right now, it's just all the U.S. stuff. But all the crypto stuff is there too. If you're interested in looking at that, I can bring you up a chart of Bitcoin. Here, there you can see Bitcoin right there. Had this big triangle, trying to give a little bit of a bounce back today. But yeah, all the cryptos, everything's there. And the international markets will be available very soon. On the ADX, the question is, what levels do I use on the ADX? I have changed the plots a little bit. 14 is the normal default setting on the ADX. I changed it to 13 because 13 is a Fibonacci number. So I'm all about all things Fibonacci. So that's a good question. And then when I'm looking at the signals here, I know if you were to go out and read about the DMI, it would tell you to wait till the ADX breaks above 25. I actually look when the ADX breaks 20. So once it breaks above 20, I tend to enter or view that as a confirmation. I don't necessarily wait for 25. For me, if all the other rules within the DMI with the two directional indicators, everything else taken into account, once it breaks above 20 and there's separation between the two directional indicators, et cetera, you get in just a little bit earlier than if you wait for the ADX to go to 25. But on the plots, on the settings, I did change that ADX setting from 14 to 13. So that's a good question. Get an opportunity to take advantage of that. Somebody else trades within the wave 3. That's good stuff. Yeah, it does work with Forex. Yes, I'm obviously a big fan of that, trading within the wave 3, and it never made sense to me with all the wait for that wave 1, 2, 3, and 4 to finish. And then trade the wave 5, and trading with the retail public instead of the institutions trading with the big money never made sense. So with that, David, I think it's time. So I will turn things back over to you.